Hey everyone, welcome to episode 2 of Words of Wisdom. Charlie Bilello here. In this show, I break down famous investing quotes and tell you how you can apply them on your own investing journey. Today, I want to talk about a quote from the great Peter Lynch. Peter Lynch, if you're not familiar with him, was the manager of the Fidelity Magellan Fund from 1977 to 1990. He actually generated an annualized return of about 29% per year. Pretty incredible. Nearly double the S&P 500's return during that period of time, and went out on top, went out in his mid 40s and stepped down from managing that fund. One of the great track records in history. Also wrote the book One Up on Wall Street. Highly recommend that as one of the first books to read on your investing journey. Here's the quote: "You get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the market." So a lot to unpack here. What is he talking about essentially? Well, the fact that if you're a long-term investor, you have 10, 20, 30 years, you should expect to have many declines along the way. You should expect to see many economic downturns along the way. And if you're not understanding that going in, then you're likely to panic at the first sign of trouble and get out and interrupt compounding, which is what we talked about in episode 1, what you don't want to do. But when you first start investing, the reason why this is so difficult is you don't often focus on the risk side. You don't often focus on stock market declines. You hear about the upside. This is what gets you excited about investing, is the fact that stocks have done about 10% per year over the last 100 years, including dividends, versus 4.6% for bonds, looking at the 10-year, and looking at 3.3% for cash at the 3-month Treasury bill. So what you should be asking, though, looking at this chart, is what's the catch? How do I get that higher return? Is it simply a free lunch? Very much not the case that you're getting that higher return for nothing. You're getting it because there's risk. Now, the problem is when you look at a chart, a long-term chart of the stock market, it's hard to see that risk, especially when you're at all-time highs like we are today, and especially when you're looking at a chart from the bottom in a bear market. It looks like it was such a smooth, easy ride. This is a chart showing you the returns from the low in March 2009, from that bear market low. Well, we've gone up 10x in the S&P 500 since then, 942+% return, enormous return. And it seems like, well, this had to be a pretty easy ride higher, but in actuality, not the case at all. The reality was it's never easy as an investor. Even though this was an awesome 15-year period for stocks, there were still 27 corrections, and I've listed them here, greater than 5%. You've probably forgotten about a lot of these different corrections. I'm sure you still remember 2022 with the inflation and the bear market, 27.5% decline, but many of these other declines you probably have forgotten about. And this is just proof that it's never easy. Even during a period that's very strong for the stock market, you have these types of corrections, and that's the precise reason why you're getting that higher return. Now, each and every year, what should you expect as an investor? You should expect a drawdown at some point in time. It's very unusual to have a year where you don't have at least a 5% pullback. We did see that in 1995. We saw it again in 2017, but those are abnormal. Those are not typical years. You should more normally be expecting at least 5%. And actually, the average since 1928 has been a 16% intra-year drawdown, the median around 13%. Last year, 2023, probably a perfect example of this, 10% drawdown, but that did not prevent the stock market from actually rising 26%. So feature of the market, not a bug, the fact that you have this volatility each and every year. What about bear markets? How often do they happen historically? Well, once every 4 years on average, but that doesn't mean it's like clockwork, like you're going to get a bear market this year and then again in 4 years and then 4 years. No, they can happen in bunches. They could be spread out more infrequently, but at every 4 years on average, we've seen a 20% decline. 30% decline we've seen every almost 8 to 9 years, and a 50% decline roughly every 19 years. So if you're investing for the next 20, 30, 40 years, you should be expecting at a minimum to see multiple bear markets in excess of 20%. That would be very, very normal in terms of what has happened historically. And if we look at recessions here, what should you be expecting? Well, that they happen, that they're going to happen. You can't predict when they're going to happen. You certainly can't get the timing of it right in terms of getting in and out of the stock market. No one has been able to do that historically, but you can see here enormous gains for the S&P 500 since 1950. And we've had 11 different recessions, once every 6 to 7 years or so on average. That hasn't prevented the higher returns in the stock market. That hasn't prevented investors from earning over 10% a year since 1950. And in fact, it's been one of the reasons why investors have earned this return is the fact that there has been risk embedded in it. So the risk of that economic downturn impairing earnings is one of the reasons why you get this equity risk premium, a higher return on stocks than bonds. And if we look at recessions, the one thing that you can be certain of is that they don't last forever. Recessions tend to be shorter than expansions. We don't know how long they're going to last once they start. In 2020, of course, we had that very brief 2-month huge downturn when the economy was shut down during COVID, but we recovered from it. We had a new expansion. We hit a new high in terms of real GDP. And now the economic expansion today, incredibly, is almost 4 years old already. So when you're in the midst of a recession, it can seem like it's going to go on forever, but there's always light at the end of the tunnel. Every recession in the past has been followed by an expansion, and I suspect that will be true again in the future. Now, what's the question this year? The big question is, has risk been eradicated? Why are investors asking that? Well, we've hit 22 all-time highs in the first quarter of 2024, and we've done so with very little risk. So it's very rare to see this type of upside with very minimal downside. There's actually only been a 1.7% max drawdown in the first quarter of this year. And as we showed earlier, that's very atypical. Typically, you have a 5% or more drawdown. In 2023, we had a 10% drawdown. So don't expect this to continue. Risk has definitely not been eradicated. What I like to say is risk is always there, even if you can't see it. So coming back to that quote from Peter Lynch, if we're thinking about it today, if you're a new investor and you just started this year and you're not seeing any volatility, you're not worried about a recession anymore, well, be prepared for it. If you're thinking you're going to be in the market for 10, 20, 30 years, there's going to be another big decline. There's going to be another recession. And if you're not understanding that's going to happen, and you're not saying I'm going to stick it out through that time and maybe even invest more when the stock market's at a more attractive level, when you have better valuations, then you're not ready. You won't do well in the markets because, as we talked about in the first video, you can't interrupt compounding. You can't sell out after a big decline. It's going to ruin most of those long-term gains for you. So if we look at that chart of return, this is a great chart for investors to understand, but they have to be familiar with why you're getting it, why you're getting that higher return on stocks. And this is the reason. It's because there's higher volatility in stocks than in bonds, over double the annualized volatility. That's why you're getting that higher long-term return. And the path to wealth, what I like to say, is not a straight line. So as an investor, you should be expecting a lot of volatility. You should be expecting a long and winding road to wealth, with the rewards at the end of that road being tremendous. So with that, we'll end it there. Thank you for watching the video. Hit that subscribe button for more content just like it, and I'll see you next time on Words of Wisdom.